You've been searching for the best way to generate passive income in your life and heard that real estate is a great way to do it. But you're tired of all the so-called gurus who are all talk and no substance. Get ready to celebrate because Kevin Buck has spent 14 years successfully making it happen. This is the Real Estate Investing for Cash Flow podcast. Now, here's Kevin Buck.
Hey guys, Kevin Buck here, and welcome you to another episode of the Real Estate Investing for Cash Flow podcast. Our mission is to help you build and maintain massive amounts of cash flow through income-producing real estate investments. Our guest for this week's show is multifamily and commercial real estate investment expert and co-founder of the Bascom Group, Jerry Fink. Since being founded in 1996, Bascom has completed more than $15 billion in multifamily and commercial value-added transactions, including more than 600 multifamily properties and 160,000 units. This ranks Bascom among the top 50 multifamily owners in the United States. Now, during Bascom's early years, the business plan was to acquire and reposition 300 to 500 unit apartment buildings in the midst of the foreclosure and jobs crisis of the 1990s in California by creating value-added renovations and community outreach programs. During the late 1990s, Jerry Fink and Bascom acquired 52,911 apartment units within 199 redevelopments and 3.1 million square feet of industrial and office properties, totaling in excess of $6 billion in transactional volume. And now, just to offer you guys some personal insight as to the overall success that I've personally witnessed by Jerry and his group. If you don't recall, I interviewed Jerry way back on episode number 91, which was, I believe it aired in October 2015. I'll have the exact date, but I do believe it aired October 2015. At that point, Jerry and his group had transacted an estimated 70,000 doors, multifamily doors. And now, in just the last 3 years alone, the Bascom Group has more than doubled their multifamily transactional volume to that 160,000 doors I had just mentioned earlier. And so with that, guys, I'm incredibly excited to get onto this call with Jerry and see how things have been going over the last 3 years. You know, basically it's been 3 years since we spoke. I want to get an update from him and find out how things are going. So before we get onto the show though, I want to go through a quick word here from our sponsor, Sunrise Capital Investors. Hey guys, Kevin Buck here with Sunrise Capital Investors. As you are hopefully already well aware if you've been a listener for any period of time, my goal has always been to provide you with as much value as I possibly can through my two podcasts, Real Estate Investing for Cash Flow and the Mobile Home Park Investing Podcast. As our audience continues to grow, literally, we've been downloaded millions of times by folks in over 125 countries. I've had thousands of people reach out looking to get involved in our niche. And that's the phenomenal niche of mobile home park investing. For those that don't know, I've been a full-time real estate investor for nearly 20 years now, and I've personally invested in and have owned apartment complexes, various commercial properties, hundreds of single-family rentals, and I've interviewed some of the most successful investors in just about every other asset class, and I've arrived at this one very simple conclusion. Mobile home parks are hands down the best investment I've found to date. Why? They provide investors with the best risk-adjusted returns out of any other real estate sector that I've seen. Investing in real estate can get complicated, and I really want to simplify this process for you. If you're someone who wants to diversify away from the uncertainty of Wall Street and allocate a percentage of your real estate portfolio to mobile home parks, but maybe you don't have the time nor the inclination to personally locate good deals yourself, then our team will do it for you. At Sunrise Capital Investors, our team specializes in the acquisitions and management of undervalued and highly profitable mobile home parks. And we are now providing accredited investors with an opportunity to participate directly alongside our team in our up-and-coming deals. And let me say this, I believe that we are hands down the best in our space at sourcing highly profitable off-market deals. That's really what makes us unique in this niche and as investment managers. As stewards of your capital, we truly are aligned with our investors. We've structured our investment fund so that we as a company are incentivized in the same way the investor is, which is through the performance of the investment itself. In addition, we want to make sure that we not only make money for our investors, but that they understand how it's being made. That's why we provide our accredited partners with a private monthly podcast that walks them through the detailed updates on how their investment is performing. And we're very transparent, providing you with the good, the bad, and the ugly at times. And so if you'd like to learn more about the partnership opportunities with our team here at Sunrise, please go visit sunrisecapitalinvestors.com and click on the investors link to get signed up. It's absolutely free and you'll get placed on the priority list of when new opportunities come along. Also, feel free to call us at 833-CASH-FLOW without the O. Again, that's 833-CASH-FLOW without the O. And one of our investor relations team members will help you schedule an appointment to speak with one of our managing principals. If you have questions, go ahead and schedule a call and let's get on the phone and talk. And with that, guys, I like to leave with one last thought. From the time that I wake up in the morning till the time that I lay my head down the rest of the evening, my number one priority with everything I do, whether it be recording this podcast, working for our investors, helping each of you reach your investment goals, to providing a great experience to each of our residents who reside in our communities, is to add huge amounts of value to everyone that I come in contact with. Now, with that being said, I look forward to the opportunity of bringing value to you through Sunrise and through this podcast. Thank you for your time. Now, let's go ahead and get back to the show. Alrighty, guys. Now I'd like to welcome our guest for today's show, Jerry Fink. Jerry, how you doing today, my friend?
Good. Thank you, Kevin, for the opportunity. Looking forward to the show.
Yeah, welcome back. Welcome back. It's been 3 years. As I just mentioned, you've had a lot happen in the last 3 years. You guys are just it's like wildfire, man. Like you guys have got 120 octane boost behind you, and you guys are just growing by leaps and bounds. So it's quite exciting. I'm really looking forward to getting an update from you to find out what's changed in your business. So really looking to hear your perspective of what's happening over there at the Bascom Group. And before we do, Jerry, what I'd like to do here, for those that aren't familiar with you, again, we've interviewed you 3 years ago, and I know you've been interviewed on multiple other podcasts, but for those that don't know your story, don't know the story behind Bascom and its founding back in 1996, maybe take a few minutes, give us a little background on yourself and the overall formation of Bascom, if you would.
Sure. Just a quick background on Bascom Group. We formed it back in 1996, and the partners and co-founders are David Kim and Derek Chen. We all went to school together at the University of Wisconsin. Dave went to work for Disney Development Company. Derek went to start a development company in Las Vegas, worked for Pacific Life. We all took different career paths after graduate school at Wisconsin. And in 95, Dave Kim and I sat down and put together a business plan to acquire value-added apartment buildings in Southern California. And our thought was we'd partner with institutional investors, buy them, reposition them, sell them for a profit. And so we put together a business plan, approached Derek Chen. He funded it, and then the rest is history. So we started with fairly humble beginnings back in 1996, but we've stuck to a very basic premise, which is looking for distressed or value-add multifamily properties where we can put in new management, renovations, capital improvements, to improve those buildings and buy a B or C building and take it to a B or an A building, and hopefully partner with investors, whether it's private or institutional, hold it 3 to 5 years, and then hopefully sell it for a profit. And so our initial focus was really on Southern California, mainly Orange County. Since then, we've kind of expanded to Southern California, Northern California, and then pretty much now it's the entire U.S. that we're active in and buying multifamily properties in. And we're not only active in doing value-add multifamily, but we've also focused on creating a number of other portfolio companies. And we've linked up with other entrepreneurs to give them capital and help them grow their business. So we've done everything from executive suites or co-working to industrial, office, retail, apartment development. We even do GP co-invest sponsor funds as well. So we do a variety of other things. We've got 15 different portfolio companies that do other things other than value-add multifamily. They're all real estate related, but they all have a similar premise, which is looking to create value by either entitling land or buying existing buildings, whether it's industrial or office. But our core business really is value-add multifamily. And so a typical deal for us might be 10 million to 50 million in size. And we look to spend anywhere from $15,000 per unit to $50,000 per unit doing upgrades to the interiors, to the common areas, to the exteriors. And our goal, again, is really to take a building that is underperforming or mismanaged, and by adding improvements to it, take it to the next level. As you mentioned, since '96, we've done about 15 to 16 billion of transactions. So a very active group in buying and repositioning multifamily.
I'd love to better understand your definition or Bascom's definition of value add or distressed, whatever that means to your company. You guys have essentially acquired 90,000 additional doors in the past 3 years since we last spoke. And so give me an idea of what those acquisitions look like to you. What really is a value add opportunity in your eyes?
Sure. A value add is, it can range from an A building to a C building. We bought A buildings where they were brand new and we thought, well, we can spend some money, upgrade the pool furniture, we can upgrade the gym, we can put in crown molding in the units. So even an A building, there's things you can do to improve them. But obviously, people think of a B or C building, meaning it was built back in the 1960s, 70s, or 80s. And typically the older buildings have carpeting or laminate countertops or white appliances or shallow sinks, or they might have a gym that's got chrome universal equipment. So value add is, can we put improvements in the building, whether it's new flooring, new countertops or kitchens, or build a new gym or a playground area, or repaint the building or put new windows in, something to improve the appearance so that it doesn't look like a 1970s building, it looks like a modern building, and hopefully raise your rents. And we typically target at least a 10%. We prefer about a 20% return on investment. So, if we put in a new cabinet faces and they cost, $1,000, say, we want to make sure it generates at least $100 to $200 of additional revenue per year. So we look at, by making these capital improvements, can we increase the rents that a consumer will pay because it's nicer quality? So we look at all those things that will help raise the ability to charge higher rents. And it's not only on the income stream too. We look at the operating expenses and, can we retrofit low flow water saving toilets? Can we put in energy efficient lights? Can we operate the property with less staff? Can we appeal the taxes? We look at all those things to really find ways to reduce operating expenses as well.
Let's talk about your team. I mean, building out Bascom, those three of you that started, I'm assuming the three of you wore a lot of different hats back in 1996, just like we all do as starting out to be entrepreneurs, starting our own businesses. Talking about how you morphed into what you are today. What does that look like as far as building a stout team behind you? Not just a stout team, but a dedicated team of talented folks. And I'm assuming to get to the size that you guys are today, you've had to also create a very strong internal corporate culture that not only attracts folks, but also retains that top talent. Can you talk to me a little bit about that?
Sure. I think that's critical. And, we've had a pretty young staff over the years, but they've been young, but very experienced in doing renovations. And what we tried to do is have everyone here become partners. So on a typical deal, all of our employees, whether it's the acquisitions or operations or renovation side, they all participate in the profit that we earn off an investment. And so we live and breathe off what's called the promote or carried interest, which is if we sell the building for a profit, we get some percentage of that profit as kind of our incentive for buying and repositioning this deal and making a profit. So of that carried interest, or promote they call it, or profit sharing interest, we take a percentage of that, allocate that to the acquisitions and operations and renovations team, so that all of the team members from day one to kind of the very end of the transaction who are involved in it can participate in the profit, and it turns them into, from employees to partners. And when you're a partner, you take a much different kind of look at a deal, and you work harder and you have a lot more vested interest if you were just an employee or in a bonus. So we try to turn people, again, not just from employees, but into partners. And then second is we try to give our employees or partners not only a lot of responsibility, but a lot of authority. Because our goal is to create a very flat organization where you have to make changes or decisions. We can do them very quickly, because in the value add renovation game, it's very important that if you find challenges or issues, you can make decisions and move forward and not get stuck or held up. And all of a sudden, your renovation takes 2 or 3 years to complete versus 1 year. So, we try to create a very flat structure with a lot of authority that comes with responsibility. And then we also try to incentivize our employees that, our goal is we want everyone here to become millionaires. And they can do that by participating in the transactions. And if they do well, they get some share of that. And hopefully over time, that share of the promote will be very valuable. And then I think third is we let them invest in the deal. So even though they're making money here with their profit participation, all of them invest money in the transaction. So they're not only a promoted stakeholder, but they're an actual capital holder too.
I love that. Yeah, I love every bit of that. That's awesome. Talk to me about the state of the multifamily business today. I know that you guys have acquired a lot over the last 3 years, but where are we at today? And I know you're nationwide, so it's all relative, right? Every market's a little different than the next. You guys have got a very heavy emphasis on California as a whole, but just generally speaking, if you could just paint a broad brush stroke across the country, where are we at as far as multifamily is concerned today in the current real estate cycle that we find ourselves in?
I think that, looking back at my 20 or 25 years in the business, it's the most challenging time in the multifamily business. And the reason for that is the expected yields, not only in place, but our pro forma, 5-year leveraged IRRs, they're the lowest I've ever seen them. So the cap rates are, other than maybe a C building in a tertiary market, most places cap rates are sub 5% now. They're 4.5%, 4.75%. So cap rates are very low for multifamily, especially the nicer, newer properties in desirable areas. So the going in place cap rate is the lowest I've ever seen it. The projected returns are the lowest I've seen that. And the reason for that is there's just a tremendous amount of capital flooding into our space. And they like the prospects of multifamily, like the safety of it, they like the cash flow. As a result, it's driven those yields down to, again, the lowest I've ever seen them. Second, my concern is, there's a lot of new supply happening nationwide. Now, granted, it's concentrated in a lot of urban infill areas and it's Class A. So the C and D buildings aren't as impacted, but there's a lot of new construction going on in a lot of major markets. And in most of those major markets, it's a little bit soft right now. They're offering a month, 2 months concessions. Rents are flat or even declining. So you've got a lot of supply happening right now. And then I think third is, we've kind of all sold ourselves on the millennial boom, which is this giant kind of demographic, bulge going through the pipeline. And in 5 or 6 years, that surge, millennials will start declining over time. And so, those are our 3 big concerns. One is really yields are lower than we've ever seen them. 2 is perception of just a lot of supply in the U.S. And 3 is this millennial boom, which might end in 5 or 6 years. So those are kind of the 3 things that we're a little concerned about. Just that, and I think fourth really is, there's a tremendous amount of capital that likes to buy value-add deals. Value-add multifamily is kind of the hottest thing right now. And because of that, that's driven down to it's kind of lower than ever. So.
Let's talk about the millennials for a second. Let's talk about that demographic. And, they're renters. They like to be transient. They watch their parents go through, the crisis in 2007, 2008, where their parents, might even have lost their home, lost money in the stock market, could have lost their job, could have lost many things, right? Had a very challenging financial time. And I know that a lot of the growth in the multifamily space is really geared towards, at this point, towards this millennial boom. What do you foresee happening as far as the trends are concerned, going from renters to homeowners? I know that home ownership is at an all-time low, but where do you see that shifting back at some point and kind of at least becoming a little more even-keeled as far as that demographic once they get a little older and start having kids? I mean, at some point, most people like to settle down. Right?
Kevin, you bring up a great point, which is I think people looked at this millennials crowd and said, hey, they don't want to buy a house. They want to go travel the world. They want experiences. They don't want to have kids. And it turns out they do want to buy a home. They want to have kids. They want to settle down. And you know what? They want to move to the suburbs because the schools are good there. So all these things that people thought, were not true about them, they're true. It's just they're happening at a later point in their life. But second is, as much as they want to buy a home, have kids, and move to the suburbs, the challenge is a lot of them don't have great credit. And second is it's still very difficult to get single family financing, and they want down payments today. And so the challenge that the millennials are having is, I've waited longer to settle down. I want to move to the suburbs and have kids, but I can't afford the home I thought I would buy. In prior generations, the homes were much cheaper. You got better financing. And so that equation worked out. This generation, they're all going to want to buy homes, have kids and move to the suburbs. But the homes now are very expensive, and that's what's made, rental housing in the suburbs attractive. And second, rental homes have become very attractive too, because a lot of millennials have said, well, if I can't buy a home, I'll go rent one and save up money to go buy one eventually. So I think we see that as a change. We see the home ownership increasing because the millennials do want it. And, I think the oldest millennial today is 35. So they're at that stage. They're going to start buying homes and settling down. They just take them longer to do it, and they're struggling to buy the home because of down payment issues.
Mm-hmm. So how does someone like Bascom, how do you guys shield yourself from those types of risk? I mean, because I look at that kind of gets paired with the oversupply risk as well, right? We keep building for this demographic that at some point in time will slowly shift away from being a renter to hopefully being a homeowner, right? If the cards are in their favor. And so how do you protect yourself and insulate yourself from those types of risks?
Well, the other theory is that the older couples that are in the suburbs, the kids that all went to college, they're going to go, hey, why don't I move downtown and have this urban lifestyle because my kids are all gone and I like being able to walk to restaurants and shops. So kind of the theory is, the millennials get married, have kids, move to the suburbs, and then the parents and grandparents go, it's boring living in the suburbs and no kids, I'll go live in this urban lifestyle. That's kind of the theory that's going on.
Right.
But to protect ourselves is we try to buy in markets that have, barriers to entry and where homes are expensive. And so even if people want to buy homes, maybe it's San Francisco or Los Angeles or Orange County, it's so expensive to do so that, you rarely lose a lot of renters to home ownership. If you're in Phoenix or Las Vegas, that's a little bigger factor. But it always seems like there's a lot of demand for apartments, whether it's Phoenix, Las Vegas, or Orlando. And so as much as we see the home ownership rate improving and, rentership rate declining, that's a trend that's fairly slow in the making. So, don't expect any major changes kind of year over year to do that. But how we protect it really is buying in strong markets with very expensive home prices. And so we look at new deals. We look at the cost to buy a new home, both on a down payment, and we look at the monthly payment. And we try to buy apartments where, the apartments are much less than a single family, monthly payment, so that it's very, it's not conducive to moving from apartment to single family.
Understand. So talking about cap rates being so low, that's not very exciting, right? Being from a buyer standpoint. What is exciting for you guys now at this point in the game? I know the deals are a little bit hard to come by. I don't know what your ratio is of how many opportunities you have to look at before one sticks nowadays, based on your criteria, your buying criteria. But what excites you other than cap rates not being all that exciting? What actually really gets you jacked up about where we're at in the multifamily space today overall? Sure.
Well, I think the one area we're really excited about is as much as the Class A market in some of these urban areas is soft and they're offering concessions, well, we think that could be an opportunity. So, a lot of institutional investors today are saying, I don't want the Class A urban brand new deal because the market's soft and there's more supply. They've all said they want to buy suburban, value add B buildings. And so we've thought, let's go opposite to that direction. Let's go find those opportunities of brand new Class A buildings that we can get at a good basis. And our belief is that in 2 or 3 years, when this new supply stops, those markets will tighten and we'll bought some really good deals, because a lot of developers built these buildings, anywhere from 2 to 3 to 4 years ago. They got really good deals in the land and they got a much better pricing on labor and materials. So they built it for a price that they can still make a profit on, but it's a big discount to today's replacement cost because land has gone up, materials have gone up. And so we bought a number of Class A buildings in the past couple of years where, there wasn't a lot of value add, but we believe we're getting a very good price on a per unit or per square foot. And our belief was the markets would eventually tighten and when new supply stops. And, that's kind of our business plan, what gets us excited about those opportunities. So I think we like the idea of buying the distressed Class A that's in a soft market today. 2 is, if you're doing value add, there's still value add deals kind of wherever you go, whether it's Orlando or Las Vegas or Los Angeles. So, we can always find another 1970s, 1960s building that is in need of a renovation. And so we're looking for those opportunities. They're tougher, but those are still out there as well.
I want to talk a little bit about the management of your portfolio. And I'm assuming at this stage, the size of Bascom, you guys probably have internal management, right? Your property management's internal and in-house. Is that correct?
No, we're just the opposite.
Are you really? Wow.
Yeah, we always believe that, we can go to a market and find a better third-party fee manager. And so every year we debate, we do our own management, and we always say no, because we can go hire a Pinnacle or MBB or Greystar or some group that has got a lot more units, is well established, and they specialize in property management. And so, we'll go to a market, we'll interview a couple firms, we'll try to find the best fitting third-party manager. And what we do is rely on all of their local expertise to benefit from that. And then we overlay all the best practices we've learned working across the country. And so we try to find the best property manager and then overlay the best kind of asset management or company level oversight to kind of get the best results.
Mm-hmm. Do you typically require that these third-party fee managers have actual skin in the game, that they actually participate with you in the investment? Sometimes we've done that. Typically the groups we've hired, they're third-party managers, and so they work on a fee basis, but we create incentive structures for the on-site, and we also create incentive structures for the property manager that if you hit a certain income level or net operating income level, you can earn additional management fees to help align, the property manager with our objectives. I'm assuming that based on the number of communities that you currently own, you try to maintain some diversity, not having all of your eggs in one basket with one property manager in any given region. So do you have a certain formula that you utilize as far as like how many units we feel comfortable with having with this one fee management company? I mean, region by region, it doesn't really matter. We want to find the best in this region, and we'll give them everything that we acquire within that region.
Yeah, I think if they're doing a great job in a region, we might give them everything. But second, we always like to have a backup with another property manager, because sometimes you'll find that, a property manager in a certain market might be great, but they just can't seem to figure out one building. Maybe it's the location, the temp profile. And so we like to have at least another, number 2, number 3 property manager that, hey, if that first one's not working out, we might swap a second one in and see how they operate. Because sometimes it comes down to the regional manager. It comes down to like their knowledge or desire and attitude toward the building. So, it's not uncommon that we have to replace a property manager and bring in someone new with a fresh perspective. And so, we'll do that. Hopefully we don't have to do that, but if we have to,
Okay. I'd like to switch gears a little bit now, Jerry, if you wouldn't mind. I want to talk a little bit about a little bit more of a personal side. Let's step away from business for a little bit. It's all kind of interrelated. As far as daily routines are concerned, I mean, you're an incredibly successful individual, and I'm assuming that you've got a lot of established habits that have helped propel yourself to the success that you find today. And I'm a big fan of daily routines. I typically wake up before the rest of the family wakes up. I get, normally most of the days of the week, I get an exercise routine in. I take a chance to journal a little bit, read a little bit. And I find that gets my day started off on the right foot. And I really attribute a lot of my overall success to that routine, right? And so how about yourself? I mean, do you have any kind of rituals that you live by on a daily basis?
Yeah, okay, but I'm a workout junkie too.
Okay.
So I'm kind of the opposite, where like, I sometimes work out in the morning, but a lot of times work out at lunch hour or after work. But it's critical for kind of everybody out there that, it's great that you can make money and have a big company and do all these great things. But if you're not healthy and you end up dying at age 60 or 50, that's not a good thing either. So I've really strived to work out. I work out sometimes once, twice a day. So I go to the gym, lift weights, I do yoga, I do spin, I do boxing. I try to do a variety of things to stay active, and not only to work out and do different things, whether it's weights or spin or yoga, but to also try to eat healthy and very nutritious breakfast and lunch and dinner, and do both work out and eat healthy. And so I think that's critical. And even meditation, I kind of get that from yoga. I love hot yoga, which has been a great stress reliever for me. But our business can be very stressful, especially if you're doing value-add renovations. So you got to find those to stay in shape. But I think it's working out is probably critical. Eating healthy is number 2. And I think 3 is, at my age, I've learned to kind of say no more. When you're younger, you can say yes to everything. It's great. You can volunteer and do all these things. But when you get older, saying no to things becomes critical because there's only so many hours in a day and so many days in a week.
Mm-hmm.
So I find myself more and more declining social events or declining activities or saying no to projects so that I can actually, be able to function in life and
sure,
be a decent family member. So,
well, thank you for saying yes to us. Let's talk about that, about family. Because it really
Sure.
ties into. I've got 2 young kids. I've been married for 9 years now. I've got 2 young boys, a year and a half and 4.5. So I'm just really kind of got started late as far as having kids, and but I wouldn't trade it for the world. It's really the most important thing to me, and obviously. Your work occupies a lot of time as you're growing a business, right? There's always something to do. There's never enough hours in the day. And so you really have to be diligent and focused at carving aside that time for the things that are important in life, family, health, fitness, all those. So talk to me a little bit about how you've been able to continually grow this hugely thriving company, maintain this incredible company culture, but also maintain a work-life balance that works, that allows you to spend adequate amount of time on each.
Sure. Well, it was interesting. I went to a conference a while back, and it was 4 legends in real estate, and they asked the same question. They said, how do you have work-life balance? And they all had the same answer, and they said, you can't. And they said, if you're going to grow a very successful company, there's going to be sacrifices, in regards to your family and family time. And I think that you have to be realistic. I think it's impossible to have this perfect balance where it's equal family, equal health, equal business. And because things do suffer when you're growing your business and putting in, 100 hours a week to grow that, it's difficult because you can't make that up somewhere else unless you're not sleeping, which is not good. So I think it's, critical that you kind of realize there's going to be some sacrifices with your family, your health. And that's kind of the price that you're going to pay to grow the business. And, if you want to work 6-7 hours a day, you can do that and have this great family life and do these other things, but your business is not going to be the same as if you put more time into it. I think it's also important too is, to be able to spend time at home or with your family or work out, it's critical that you hire people that you can delegate to get the job done that are qualified so that you're not doing it. And I think as an entrepreneur, one of the biggest mistakes you make is you try to do everything yourself. And after a while, you run out of time to do everything yourself. And, I think one of the things that helped us at Bascom is we hired great people that, were equal or better than what we were. And so, in some ways, our life has been a little easier because we have a very high-functioning team here. The toughest year was probably our first year where it was David, Kim, myself, and we had nobody else. So, if we had to get paper for the fax machine, Dave or I drove to Staples and spent half hour doing that. And then we hired an analyst and he went to Staples and realized, wow, our productivity. So, those are all things that we've learned is hiring great people, delegating. And if you can do those things and not micromanage, you're freeing up some of your time to be able to spend time with your family or go work out.
All right, when you're in that hiring mode, especially when you guys were just first getting started, did you ever feel like there was a period of time where you hired too soon? I've never heard anyone complain about hiring too soon, more so hiring too late, right? Like you're like, I can't do this anymore. We're all in the office, 16 hours a day, 7 days a week. I'm going crazy. And I literally still haven't been able to keep up with the workload. We need to get someone in here, right? To offload these items too. And then I feel like that's typically how organizations grow. We're trying to have a completely opposite approach here with our company. Like we've been actually hiring ahead of time. And it's a really challenging decision to make because it's expensive, but we're figuring out how to afford them, right? It doesn't matter. It's not an option to us. We're hiring the top talent that we feel like we're going to need a year from now, 3 years from now, 5 years from now, and we're being proactive about it. So talk to me a little bit about how you guys handle those decisions. Yeah,
that's a great thought. I think we've probably made a very similar mistake where, our view has always been, we'll just kind of work later and longer to get the same job done. And we kind of held off hiring, maybe someone that could have helped us. Every time we hired someone to help us, it was our productivity exploded like 2 or 3 fold. So it's the best investment to hire those people. And our regret is we should have done it sooner. And so I think we're involved in all oil companies too, where I see the same mistake as everyone fears. Oh my gosh, I have to hire this analyst and it's $60,000 per year. But I tell them, if you get an acquisition fee of 1% and you buy one deal for $6 million, he's paid for himself. And
yeah,
you'll do at least one more deal if you hire that person. And you probably say, well, I think I need more deals. So I think that's the mistake we made, is we should have, as you said, been more proactive in hiring people versus waiting for the growth to happen, then doing it afterward. Because every time we've hired the person, we always look back and said, wow, that we should have done that sooner. So.
Mm-hmm. Well, it seems like you guys are doing quite well with your plan in place. So, how about favorite business book? I mean, do you have something you're reading right now that you're in love with? I mean, I don't know if you're an avid reader or not. I'm assuming you probably have a fair share of books.
The book I consider the Bible is the Benjamin Graham book that Warren Buffett always references, value investing. Mm-hmm. If you read the book, Value Investing by Benjamin Graham, it's when you get in these areas where things get frothy and prices keep going up and cap rates get low, that's a great book to read and to really kind of bring yourself back to when you buy something, you have to get a good deal. And, much like Warren Buffett, if he can't get a good deal, his view is, well, I'm not going to buy. And I think that the biggest mistake that we all make in this business is when you're in this big upswing, you feel like if you're not buying, you're not participating. Yeah. And sometimes you have to say, well, I'm just going to sit this out because if I can't get a good deal, I'm not going to buy something for the sake of buying it. And so I think that, that book is a great read. It's an old book back in the 40s or 50s, but, it's also the number one book that Warren Buffett says that he kind of references. And, again, whenever you kind of get caught up in the hype, it's a great book to read to kind of reground yourself onto what you should be doing.
A lot of the frothiness that's happening today, a lot of the acquisitions that are taking place, do you think a number of those assets are going to come back around in the next 3, 5, 7 years?
Yeah, I think the biggest thing we see is, we don't expect a crash to happen. Yeah. We view the market as kind of fully valued, meaning it's not cheap, it's not expensive, it's just fully valued. Mm-hmm. Belief is for a lot of value add deals that are trading today, the investors will buy them, spend a lot of work repositioning them, and then sell them and maybe break even or maybe a slight loss. So our fear is on a lot of the deals that are being done today, the sponsor or the operator will do a lot of work, put a lot of energy into it, spend 3 to 5 years of their life, and then that big profit sharing interest he thought we'd get, he doesn't get. And so we expect a market going forward the next couple of years where, unless you get a good deal or you get in a super hot market, which is difficult today, making big returns in apartments is going to be difficult to get going forward. So that's kind of our big concern and fear. And, that's how we kind of see the next couple of years.
Mm-hmm. Is that why you guys have been diversifying a little bit with some of these subsidiaries, going to different?
Yeah.
Okay.
Exactly. So we're doing, apartment developments in California. Yeah. We've got about 8 or 9 projects there. Wow. We do industrial value add, office value add. We started a company to do creative office conversions in the Western U.S. called Harbor Associates, and that's gone great. We're involved in an executive suite company, which is now co-working, they call it. Mm-hmm. Been doing really well. So you're right, we've been other ventures that are a little different than multifamily, but multifamily, our day job, our bread and butter. And as much as we think it's pricey, there's still opportunities out there.
Yeah, well, fantastic. Well, Jerry, this has been absolutely awesome. I'd like to enter in what I like to call the golden nugget segment of the show now. And this is where we're going to work on wrapping things up for the day. I want to be respectful of your time. If you had just one final golden nugget of advice or wisdom that you could leave with our listeners here today that may inspire and motivate them as they progress in their real estate investing career, what would that one last golden nugget be?
I think the golden nugget is real estate's a phenomenal asset class for even the person with the lowest net worth, because there's nothing stopping them from researching a market, finding a good opportunity, going under contract. Even if you don't have money, you can still get a loan to borrow 70, 80% of it. Even if you don't have the equity down payment, you can go out and talk to your parents, your buddies, your friends, coworkers, put together a syndication to buy that. And if you can get a good deal, create the value, and resell for a profit, you can actually turn zero into a lot of money if you kind of repeat that same formula. Mm-hmm. And so market that we're in, whether it's Dallas or New York or Los Angeles, there's opportunities for value add everywhere. I always tell people, you don't have to buy a 300 unit building. You can go buy a condo.
Yeah, right.
Yeah, lease it up and then prove to everybody that, hey, I bought this little condo. It was vacant. I renovated it for $10,000. I'm charging $1,500. It works. And I tell people, prove it works in a condo, then go buy a duplex, a 10 unit. And after a while, suddenly you're buying 100 unit, 200 unit buildings. And I tell people too, as much as we've done $16 billion in my career, my first acquisition ever personally, I paid $60,000 for a dilapidated house in Santa Ana that was falling apart. So, all create value. We bought that, renovated it, sold it for a profit. So, the formula on that one really is no different than the formula on a unit building. So.
Yeah, no, I think you made a great point there about really just proving the concept. I mean, if you're going to get into this value add space, it doesn't have to be, your first leap doesn't have to be a 300 unit apartment complex. I mean, just prove the concept. Maybe it's a duplex, you go in, buy something at a value on the front side, make your money on the front side, do the renovations, execute the business plan successfully, right? That's the whole goal there. If you fail at that business plan, don't go try to pitch that and say, I want to now go buy a 100 unit apartment complex, right? Prove the concept, risk some of your own capital even, right? Put some of your own skin in the game and show that you're willing to kind of, put it on the line and make it happen and that you can follow through with it. And that pitch to your investors that you're going to raise capital from, whether it's family, friends, or work associates, it's going to be a lot easier, right? When you go to pitch them on that, $10 million complex versus that $100,000 duplex. So
exactly.
Well, fantastic, Jerry. This has been an absolute blast. I really appreciate you coming back on the show again for a second time. In 3 years, lots has happened, and it's been a really enjoyable talk. Lots of value that we've shared today, and for those that are listening in, if you want to learn more about Jerry and his group, you can go visit his website at bascomgroup.com. Again, that's Bascom Group. It's BASCOM, bascomgroup.com. And Jerry, that's all we have today, my friend. Really appreciate it. I look forward to following your success. You've got a lot of things going on, a lot of irons in the fire, and you're making moves happen. So keep doing what you're doing, my friend, and I wish you the best, okay?
Great. Well, Kevin, thank you for the opportunity. I really enjoyed the talk.
Congratulations! Now you've got more of the best tricks of the trade in building massive amounts of passive income from real estate. For more amazing resources, visit realestateinvestingforcashflow.com. And we'll see you next Monday morning.